My name is David Oliver. I'm the founder at Insight Marketing, also associate of strategic alliances with BCMS, and on the executive team at My Firm's app. I know a number of you are My Firm's app users, and a big welcome to you, especially today, because your push notifications will help you, as we'll see perhaps towards the end. I'm an author, written some 14 books, worked alongside Tony Margratelli and the ICPA for many years, and really appreciate all the work that Tony and the ICPA team do for us in the accounting community. I've also sold 2 businesses of my own and wished I had not. Today's material, quick introduction to BCMS. We're going to cover 3 of 8 critical factors in a business sale. I'm going to show you exactly how to achieve multiple buyers for each client sale, and I'm going to explain the special arrangement that Tony Margratelli and I have worked out for ICPA members. By the way, if you do want to make contact with me, you can either use the question button, of course, and use the question dialog box, and that question dialog box will give me direct access to any comments that you want to make, or you can contact me if you're looking at this or listening to this after the event, doing it by remote broadcast. Just contact me, david.oliver, and in this case at bcms.co.uk. I sold 2 businesses over a decade ago. I mentioned that. With one, I used a lawyer. It cost me dearly. With the other, I used a financial institution, and it cost me even more dearly. So when I discovered the BCMS process that I'm going to share, it made me realize the huge difference it would have made to me and Jill, my wife. Millions of pounds of difference, in fact. And that's one reason, Tony will tell you, why I commit to presenting 60 events a year for BCMS, encouraging accountants and their clients to discover how to sell a business for maximum value. It's also why I'm so glad that I've been able to help 2,000 accountancy firms who already do partner with BCMS. At the end of today, I'm going to give you a number of things. Plus, Tony's pestered me to give you a copy of this book, my latest book called I Sold Up. And in fact, we'll make 5 copies available for anybody who actually does want those books. As I mentioned too, I'm going to explain the special partnership arrangement with BCMS and ICPA. I'll endeavor to show you exactly how, as an ICPA member, you can take advantage of this special arrangement. And I'm going to outline where you can best help your clients exit and earn significant fees in the process. I'm also hoping to show you how you can bolt on exit planning services, or M&A as it's called, onto your firm as an extra service with absolutely no cost. There'll be no pressure today, by the way. Those of you who know me will know that this is important to me. No pressure today or at any time to engage with BCMS, either for you or your clients. No obligation. I like to use the word opportunity. So we're going to share an opportunity which I'm going to encourage you to take advantage of. Yes, of course. And the reason for saying that early on is that both Tony and I, when we've chatted this through, have come to the very relaxed conclusion that BCMS, frankly, is not right for every client. You wouldn't expect them to be. And ultimately, it's equally right that each client makes his or her own informed choice. I also believe, by the way, as an ethical consideration, it's incumbent on you and me as trusted advisors, which we are, to ensure that the right kind of clients are actually given that choice. And today's material will help you do precisely that. Brief introduction. BCMS was established in 1987 and sells more private companies than anybody else worldwide, typically selling one company in the UK alone every 3 or 4 days, much more than that if you look overseas. On the screen, you can see the league tables according to Experian, who analyze these things. And you can see last year, BCMS sold more than twice as many as the next nearest, which last year was BDO, followed by Grant Thornton, and so that list goes on. It's been that way. It's been that way for many, many years. Now, for what it's worth, we held negotiative dialogue with over 50,000 companies last year. We have some unique data resources, which I'll go on to share. And also, again, for what it's worth, recently Coutts Bank were looking for the UK Family Business of the Year. And in their process, they analyzed many thousands of companies. And unbeknown to us, we were among them. We're still a family firm ourselves, by the way. They were looking at a number of things, including the company business model, corporate governance, success of the business model, and 40 or so additional areas. We were surprised and delighted when we were notified we were outright winners of that award, again, for what it's worth. Clients at BCMS are absolutely like your clients. The split is 50-50 between product-based companies and service-based companies, so pretty much down the middle on that count. And 90% of our clients are privately owned, and most of those are owner-managed companies, and that'll be the case for virtually everyone listening to the webinar today. Now, what I'd like to do, if I may, is launch we have two very short polls just to probably give you a reflection back on your colleagues in the ICPA, and just to give Tony and I a feel of precisely how to position the content today. Would you be kind enough just to fill in that poll? It's confidential, by the way. No one else sees your answer. How many clients approximately do you have? Would you be kind enough to begin to fill in that poll immediately for me? I'd be very grateful. Just quickly type in or click the option that most represents you. If I could encourage you to fill that in really quickly so that we don't lose any time here, that'll be fantastic. A few more of you, I think, are due to complete that poll. And I will now close the poll. Let's close that poll. And let's share the results with you. Okay, you can see the spread there, 51%, 0 to 100, 100 to 250, 22%, 250 to 500, 21%. So let's hide those results and let's get back on with our content. Now, in terms of size, our clients do vary greatly. Some clients are well below £1 million turnover. We also have a good number that are well over 100 million. Of course, the 1 million and sub-million would be much closer to the typical ICA member's client. I understand that. Most businesses, as you may not know, are taken to market using a traditional route, and what is quite staggering is that the vast majority of them fail to sell, and the reason they fail to sell is they nearly always neglect 8 critical success factors. In fact, they nearly always neglect all 8, and you might be surprised at what those 8 are. We're going to cover 3 of those 8, but it's also important that we understand the trigger points for small practice clients to consider selling, because that will enable us to have the conversation in a meaningful way. And then I'm also going to share with you at the end of our time together exactly how to get enough buyers of the right kind for your client. Now, I think we'd agree it's important to understand how to help our clients think through exit. It's rarely a business decision, and that may really surprise you. And the reason I say that is, in my experience, 20 years of consulting and talking to folks, coaching folks, it's nearly always a personal decision. Yes, of course, it's got business dimensions, important business dimensions, but unless your client has a church pastor or a business coach that they fully trust, the only person ever likely to have this kind of critical conversation with them is you and me as the trusted advisor. We've talked about doing this ethically, haven't we? And I think it's possible to leave a conversation undone, and I'd like to submit to you that that is actually quite unethical. We have a responsibility, or at least that's my view, and I think it would be yours. I think we'd agree. So how do we engage then with this responsibility that we agree we have and have the conversation? Well, understanding the 5 reasons why most of your clients will contemplate selling is important. The first one has to do with lifestyle change, and I don't think this needs too much explanation. It could simply be to do with approaching retirement. It might just be impending ill health. It could just be desire for a new chapter in life. I remember talking to Mel and his wife, Mel Atkins. You'll see them chapter 1 in the book that Tony's asked me to send you. And they ran a great little business, probably like many of your clients, called The Finishing Touch. And the challenge for Mel was, business was very successful, yes, but he was working 80 or 90 hours a week, every single week. On Saturdays, he would carve out 2 hours to take 6-year-old Callum off to play soccer. And on this particular Saturday, for whatever reason, and unbeknown to Mel, things hadn't gone too well for the young lad. And the coach had apparently said to the boy, if you want to stay in the team, you're going to have to practice more. Well, burdened by this unhelpful and unwelcome piece of information, little Callum's walking home, holding his dad's hand, and at some point he looks up at Mel and says, hey Dad, coach says I need to practice more. Mel said to me, David, I hesitated 2 or 3 seconds. Of course it was enough. Sensing his dad's hesitation, little Callum pulls his hand out. Now with tears streaming down his face, he runs inside the family home, slamming the door behind him as he goes, but not before he's called back to Mel, you're going back to work, aren't you? Turning point for Mel right there. But what about entrepreneurs versus managers? And you and I can really help our clients here. Many of your clients, I can tell you, and you'll quickly clock it, started their business 15, 20, 30 years ago as entrepreneurs, full of creativity, full of passion, full of ideas, and the business has grown and grown very successfully, hasn't it? But, and it's a huge but, it's grown to the point where it's turned them from an entrepreneur into a manager. That joie de vivre is largely a distant memory on Monday mornings now, and it's not rocket science. Your client is dealing with the relentless demands, aren't they, of health and safety, employment legislation, government bureaucracy, staff problems, idiotic legislation by the bucket load from Europe, and Monday mornings are just not what they used to be. And this is a great frustration, I can tell you right now, for many of your clients. And I've no doubt some of your clients will have been at a serious stress point in this particular guise for many years. And what happens is, and you can help here, the issue is a point is reached and a line gets crossed. And when that line gets crossed, you'll spot it as the trusted accountant. Their passion goes, stress increases. And if you're an ethical advisor, this is the time to help your client consider a dream of a different future, helping your client understand it's possible to be freed from the management cage and to fly again entrepreneurially. It can be liberating. And then time. The refrain we consistently hear is, we just want our lives back, please. This business is becoming all-consuming. We can afford to take a break, but we rarely do. We live with this thing 10 hours a day. Saturdays disappear with monotonous regularity. One witty commentator wrote recently, you entrepreneurs, he said, talking about your clients, have the luxury of working half days, and you get to choose which 12 hours it is. Point well made, I think. And then growth. Isn't it the case that for many of your clients, and you've seen this with them, they grow fairly rapidly in the early years, and then they reach a point, don't they, where it's disproportionately to grow this $500,000 to $1 million business, or turn this 1 million into a 2 million business. A significant investment is always required, isn't it? Whether it's to do with restructuring or diversifying. And if your client makes this investment, you'll have spotted the cycle tends to repeat itself, doesn't it? If you and I fail to invest with our clients, then the cycle starts to decay and they start to erode their assets. Now, many of our clients, probably like many of yours, have reached this point of investment. In other words, in their heart of hearts, they believe the company has a great future ahead of it, but they also know that in order to achieve that future, it needs investment. And 10 years ago, possibly 5 years ago, they might have made that investment themselves without too much of a second thought. But today, you've got to be kidding. I just don't want to borrow heavily again. It's not appropriate. And it's interesting, it's nearly always beneficial, not just for your clients as the shareholders, but for the company itself, by the way, and also importantly, for those loyal staff on whose shoulders many of your clients have built their businesses. And then the fifth one is what we've come to call managing risk. And you'll find this one interesting, I suspect, because it may well be that some of your clients are not quite ready to exit fully. And you will quite likely then decide with them to encourage the sale of part of the company. could be a majority stake, ideally 60 to 70%. The logic for that is your client gets a premium price because they're giving a controlling interest away. The new co-owner, by the way, is likely to not be an angel investor, bank. Why? Because they all want their money back in 3 to 5 years, preferably less. Understandable for them, but totally wrong for your client as the vendor or the seller. Incidentally, your client's buyer, if it's the right buyer, is almost certainly not going to be a competitor. This surprises lots of people, and it's a great soundbite for you to introduce to your client's thinking. Last year, in fact, before I tell you last year, what I can tell you is that premium prices when selling a company are almost never forthcoming from competitors. And yet most of your clients, I can guarantee, will not even think beyond their competitors at the time of exit. Now, last year, we sold a lot of companies, in fact, just around 100 in the 12 months. And only 16% of those companies could even remotely have been deemed to have been sold to a competitor. And even some of those you could challenge me, and I'd have to accede to your challenge because they weren't actually, in fact, real competitors. They were kind of one step removed. So the logic, by the way, just to give you the outcome of this process of thinking is the best buyer for your client will be a complementary trading company, not a competitor, not an investor. Now, these 5 would be the triggers for realizing a dream, but the next question is, how does my client realize this dream, and how do I help them? Well, as I intimated early on, there are 8 critical keys. I'm going to share just 3, and the first one for this webinar is to avoid passivity. Let me give you a fairly typical story, if I may. Your client decides to sell. Where does he or she start? They've probably never sold a business before, and that's true for most clients. And they will feel as if they need some professional assistance. And they'll approach you, quite likely, or another financial advisor, can you help me sell my business? And the reason they approach us as financial advisors is understandable, isn't it? There's lots of numbers involved. The valuation question makes it feel like a financial issue. There are tax implications. And the understandable result is they start to treat it as a financial issue. Now, as ethical advisors, we'll probably say, really sorry, Mr. or Mrs. Client, we actually don't do that sort of thing, but we could put you in touch with a corporate finance group or a broker that does specialize in this so you can speak to them. The corporate finance advisor now puts together a prospectus, typically 80 to 100 pages, very boring, very rarely read, thoroughly wrong for the job. A prospectus should never be designed to sell a company. It's the wrong tool, by the way. And this prospectus is now invariably given to a junior person who's asked or tasked to find 12 competitors to send this prospectus to. Now, the reason I choose the number 12 is because that's what the FT reckons the average is. Some of my corporate finance friends say, David, actually, that's a bit understated. It's typically 20 or 30. But we got 2 problems here, folks. Firstly, 12 potential acquirers is not enough. It is shockingly inadequate. Just to give you an idea here, at BCMS, just to sell one company, on average, we'll hold negotiative dialogue with somewhere between 120 and 250 genuine potential buyers. Our average is over 200 for the last 10 years. What I'm saying there is 200 potential acquirers for each client as an average. And I might have created a credibility problem, but if I could ask you to bear with me, I think you'll see that it's actually quite obvious why this number is both achievable and important. So the point I'm making to us early on is, for your client, 12 potential buyers is completely inadequate, 20, 30, 40 completely inadequate. But the second problem, folks, is that this prospectus is sent to 12 competitors. And I've touched on this already, haven't I? The premium price that you want for your client is almost never forthcoming from competitors. Good prices tend to come, as we've seen, from complementary trading companies rather than competitors. Now, you're ahead of me, I'm sure, ladies and gentlemen, but here we have an inadequate number of the wrong document going to the wrong audience. No wonder most companies do not sell. The result of all this typically is lack of response. If your client's really unlucky, they get an offer, and Why do I say unlucky? Well, simply because it's nearly always a derisory offer, and I'm sure you've seen this. And it then paralyzes the situation for you as advisor and for your client. Is that all that can really be achieved for this business is the question. And as a last resort for this lack of response, the finance advisor or broker will put an advert either on the web or in the news world or both. Here you can see one. It's a recruitment company for sale. You can see the details of the company, some of their clients, some of the systems, and down here is an asking price of $4 million. By the way, that asking price is a value that's been calculated using time-honored valuation methods. So I can guarantee you 100% that is a completely and inappropriately wrong valuation. Some people will have found $4 million too much and never engaged, when actually they could have been shown the true value and could have been engaged. Others would have been prepared to pay significantly more, but now that number's in the public domain, of course, there's absolutely no chance. Never ever take a client's business to market with a value attached. It will be one of the most expensive things you or I ever do. Now, different types of people subscribe to these lists. Most of them are short-term investors, and they all want their money back in 3 to 5 years, preferably less. Understandable for them, totally wrong for you and me and our client. Now, I could go on about this for some time, as you can imagine, but here's the point, and I'm sure you're ahead of me. We'd never encourage our client to sell their products and services in that way, would we? Someone out there could be interested sometime. Maybe someone out there will call us. We'd have gone bankrupt, and our clients would have gone bankrupt years back. And our conviction, therefore, is this. Selling a business is fundamentally not a financial issue. Neither, by the way, is it a legal issue. Now, don't get me wrong. As financial advisors, of course you're worth your weight in gold. But you'll only be worth your weight in gold later on in the process. Good tax advice, help in the due diligence, certain other areas, it has great value. But selling a client's business is fundamentally not a financial issue. It is a sales and marketing issue. It's been an interesting observation, by the way, that at BCMS, over 27 years now of selling clients, accountancy clients like yours, we've noticed the best buyers are almost never looking to purchase. That's a striking statement, isn't it? But if I were to describe the best buyer for most of your clients with a pretty high degree of confidence, I would say they would look something like this. They're quite likely to be international. We're seeing a significant number of clients right now sold to international companies. Of the 100 or so deal completions last year, just over 40 went to an overseas buyer. So yes, the balance is still likely to be British, but an overseas buyer in the mix is really important. They're likely to be selling complementary products and services to your clients, almost certainly not a competitor, but the same type of customers that your client sells to every day are the same type of customers that they sell to every day. They'll be different in name, yes, but similar in nature. And they'll also be a successful business. They'll be a profitable business. And as a result, acquisition will simply not be on the agenda. This may surprise you. 4 out of 5 of the deals we complete, when we first approach the final buyer, they were not considering an acquisition. Now, you're quicker than me with numbers, but that's 80%. So 80% of all BCMS deals, 80 out of last year's 100, when we got to the final buyer, they had not been looking to acquire. In other words, these people are not subscribing to brokers' lists. They're not hawking down newspaper adverts trying to pick up a bargain to sustain share value. These people are not looking. And I hope a light is coming on with a particular degree of intensity here, because if you and I rely on passive means to find a buyer for our clients, if you and I rely on them finding your client rather than making it our business to find them, you and I will miss the right buyers. We have to make it our responsibility to go and look for them. So, ladies and gentlemen, passivity is a big problem which kicks in early on. Critical key number 2 is to understand the difference between motives versus multiples. And it was when Tony Margratelli was sat in our recent seminar at the Marble Arch Hotel. It was this particular section in the seminar he found so compelling. He said, David, you've got to get this to ICPA members. And I'm going to be a tiny bit contentious here, which is probably why Tony likes it. And before I talk about valuation, I want to share with you the 9 valuation methods that are classically available for advisors like you and me. And they vary from asset book value all the way down to option theory valuation, bottom right. You don't even want to ask. But if your client was to come to you and ask you to value a business, there's a 95% chance that you will use method number 5, which I've deliberately put in brown and in the middle of the screen. Multiple of earnings. It's by far the most commonly applied. It works a little bit like this. Most of you will be familiar, I'm sure. Here's a valuation form. One of our clients, they had the business valued, and they came to us and said, would you sell the business? Here's the value. By the way, just to make it crystal clear, we strongly, adamantly disagree with this value. But I need to start by explaining the method. On the left-hand side, you can see, as you would expect, last year's accounts. Here they are. But there's going to be adjustments. It's nearly always the case, isn't it? Adjustments in this case: salary, 3,000; pension costs, 6,000; legal fees, 2,000; owner's whims, 5,000. I'm sure if you looked at your client's expenses, you could quite legitimately identify some things that could be adjusted equally legitimately. And in this case, as you can see, we started with an EBIT of 65,000. We've ended up with an EBIT of, what have we got? We've got 81,000 just here. And it's this figure that's classically used to value a business. And I so strongly disagree with this methodology. Now, what actually happens here is the buyer will apply a multiple, a ratio, to achieve the value. And the most commonly applied multiple, you know this already, I'm sure, is actually 4.8 is the UK average. It's typically 5. It ranges between 4 to 6 if it's pre-tax, 6 to 7 if it's post-tax. And yes, it does vary a little bit from sector to sector. But in this case, the advisors used a multiple of 5, as you can see right here, giving an enterprise value, a business valuation of 405,000. We actually sold this company a couple of months back, and I'll share the outcome momentarily. But here's the point I'm trying to make, and here's the point Tony Margaritelli was keen that all ICPA members understood. If the buyer uses a multiple of 6, of course, it takes them longer to get their money back. If they use a multiple of 4, they get their money back quicker. The multiple used determines the rate of return of investment. That's it. And we strongly, strongly, strongly disagree with this thinking. Why? Because, in our view, this multiple is only ever in the buyer's interest. It's never in the interest of your client. Now, this might start to sound a little counterintuitive. Please bear with me. Value is not about multiples of past profit. Please don't ever tell your client it is, and please don't let anybody ever tell you it is. So back to my main point then, motives versus multiples. People buy for all sorts of reasons. But the number one reason why anyone, anywhere in the world, should ever buy a company, the greatest reason why any acquisition is ever made is the potential for growth. And this is typically divided into 3 subcategories: growth through diversification, growth through new client acquisition. You know, new client acquisition is highly expensive, particularly if it's done organically, and growth through geographic expansion. And I can tell you, folks, these 3 things overshadow every other motive for purchase. 66% of all buying decisions globally are rooted in one or more of these 3 ingredients in the potential for future growth. Now, there are other motives. You see them on the screen, and I understand: patents and IPR, cyclical balancing, defensive strategies, operational financial synergies, skill of a workforce. Sold 3 or 4 companies last year just because of the skill of the workforce. Dependable income streams, regular customers that mean the future can be predicted with little risk. And of course, they're all helpful. And yes, return on investment has to be on that list. It is a motive for purchase. It's not a great reason for your client to engage. Now, this is not an exhaustive list, but if you or I were to prioritize this list or put it in order or ranking, you'll find that number 1 overshadows everything else. It's difficult to prioritize or rank the rest with one exception. Number 8, short-term return on investment, is right where it should be. At the very bottom of the list, it's the rarest prime reason for acquisition, and most definitely the rarest reason why a premium price would ever be paid to your client. So never take your client's company to market with a value attached. It will be one of the most damaging and dangerous decisions or actions you will ever make for your client. Now, we're completely convinced we're right on this, that value's got nothing to do with multiples of past profit. And I imagine that sounds a little bit perhaps pretentious, arrogant, I don't know. But let me share with you 27 years of data that have driven us to a particular conclusion. We come to call it the 2.5 times rule. I've already suggested, or shared rather, that at BCMS, just to sell one company on average, we'll hold negotiative dialogue with 200 potential buyers. It takes us 4 to 6 months to whittle that down to the first 100, then the 50, and finally, in a very particular way, which I'll not cover today, to 6 final invited bidders. That's how we do it. Now, those 6 final invited bidders, of course, are serious. We're at an advanced stage of dialogue, aren't we? And they're invited to put in an offer at this advanced stage in a very particular way. And the amazing discovery we've made from 27 years of data is that the difference for us between the highest offer we receive for an accountant's client and the lowest offer we receive for an accountant's client is consistently 2.5 times. Yes, I literally mean consistently. Over 27 years, one company is prepared to pay 2.5 times more than the lowest offer. Let me illustrate. You see in illustrated form exactly what I mean. Consultancy business, lowest offer 0.8, sale price 3 million. Vehicle restoration, lowest offer 0.3, sale price 1. Software 1.1 to 2. Tourism 0.8 to 1.9. Translation services 0.3 to 0.7. IT and telecoms 0.3 to 1 million. Environmental equipment 0.8 to 1.8. Now we can give you hundreds upon hundreds of examples, and this is quite genuinely globally unique to BCMS. Now at some point we'd love to meet with you and your client at one of our operating centers, and you're very welcome to come along, by the way. And whichever operating center you go to, most of you will go to the one near Newbury, I think, you'll be offered access to a little area packed with scores of ring binders, each one of those in turn packed with hundreds upon hundreds of case studies, every individual page a different case study. You can turn to any ring binder at random, turn to any page at random. Each page will give you the details of the project, the client, the buyer, the financials. Turn to any one of them and you will consistently see this 2.5 times differential. We get virtually no exceptions to this. One media commentator recently actually called this the BCMS effect. Do you remember that business we looked at just now where it was valued at 0.4 of $1,405,000? We saw this company recently, 218 potential buyers located, 35 non-disclosure agreements signed, 5 prospects met, 3 came into the final bidding round, slightly lower than the normal 6. Lowest offer was $300,000. The sale price was $1 million. Can you see how important Tony thought it was for ICPA members to understand if you use a multiple based on a return on investment calculation, your client will always undersell, probably never sell. If we'd gone in with this accountant's valuation at 405, they'd never have got $1 million. And we never get this, by the way. We always get 2.5 times. So I suppose the question in your mind is quite likely to be, David, why is it then that one buyer is prepared to pay so much more than another one? And I think, ladies and gentlemen, the answer to that question is really quite obvious, but I think it's also really quite frustrating, isn't it? One company is prepared to pay so much more than another one because, frankly, they're buying for a different reason. And the frustrating truth is this, and I understand the frustration, folks, I do. The value of your client's company has got virtually nothing to do with multiples of past profit and is almost entirely related to the authentic future opportunity. It is to do with what this company can genuinely look like under the new owner's ownership going forwards, rather than what it used to look like in your client's ownership looking backwards. So why is this frustrating? Well, for this reason. How can you value your client's business then? The honest truth is you cannot. You can value it for tax and share transactions, of course. But if somebody says to you they can value your client's company, I guarantee you they cannot. They're being naive at best. Until you know the motive of the purchaser, you cannot value a company. So please don't let anybody persuade you or in turn persuade your client that they can. Now, of course, to achieve all this brings us full circle back to our opening thoughts around avoiding passivity, the importance of choice. And I promised to share, didn't I, how at BCMS, exactly how we achieved this 10-year-long average of 200 potential acquirers for each accountant's client. Well, it starts with a very simple objective, easy to say, which is to acquire as many potential purchasers as is humanly possible in the widest geographical territory. Dead easy to say, of course. But how do we do that? And this is where I think I can give you real confidence when you're talking to clients, because the resources at BCMS, I travel extensively, most of you know me. There is no one in the world that has the resources for privately owned businesses that BCMS do. 35 full-time staff with 26 languages just to find potential buyers. And two quite unique databases, BCMS DB, the internal database. Remember, I mentioned earlier, we speak to at least 50,000. Last year it was 60,000 potential acquirers. We've been doing this for over 2 decades. If I put it another way, for every accountant's client that we take to market, we speak to over 200 potential buyers. And of course, only one of those can ever be the ultimate acquirer. And we'll hold in-depth conversations, not with all the rest, obviously, but with a good number of the rest. We'll learn why this acquisition is not right, what could be right in the future, what is their strategic intent. And we log this information. It becomes a living and breathing resource that is unique anywhere in the world, as I've said. We love accountants bringing their clients to see this in action. We had an accountant's client visit us. They specialized in manufacturing playground equipment. And whilst they were visiting our research team, one of the team was just interrogating this internal database and discovered 4 companies in the last 12 months that had said to BCMS, look, if you ever get a company specializing in playground equipment, we'd love to hear about it. So, of course, the team mentioned this to the accountant's client with the names redacted, understandably. The accountant's client's jaw dropped, the obligatory 1 meter, but actually, how could we not have that data? 35 staff, these 2 unique databases. Of course, we're going to have it, 200 potential acquirers for each client. We also have probably the biggest international database of its kind anywhere in the world under one roof, totaling 160 million potential acquirers. Typically, the researchers, by the way, shortlist 3,000 potential acquirers and rigorously reduce it through conversations down to the top 200 or so. And to help them, there are news wires, deal announcements, and non-trade buyers are added into the mix. Things like the occasional management buyout where the owner wants it, the occasional management buy-in where these managers have good funds available and your client's company fits their portfolio and they go on to outbid all the others. Now, of course, you're not impressed with those stats. I understand. You want to know how we do it, and I promised we'd tell you. It works a little bit like this. We consider what sort of products and services your client's purchaser is likely to be supplying. So let's say your client was selling air conditioning systems, for example, to architects, main building contractors, and so on. We'll ask the question, what other types of products and service do those types of buyer buy? It could be suspended ceilings, raised access flooring, partition systems, structured cabling, audio visual, lighting, interior decoration, flooring, furnishing. Going further afield, it might be alarm systems, fire suppression systems. Going outside, it could be car park systems, barrier entry systems, could be catering equipment, even catering consumables, nothing to do with building services now, but still selling to some similar types of decision maker. And what we discover over the years is that the ideal purchasers are usually located in this unfortunately coffin-shaped area of overlapping boundaries. We're looking beyond the obvious here. Give you one example and then begin to come into our concluding slides. We had a company called TMP, Traffic Management Products. They manufacture parking bollards. If you've got a town center car park outside your office, you've got one of their bollards that you lock into place. We identified 229 potential buyers, 25 non-disclosure agreements were signed, 5 offers. Lowest bid was $1 million, the highest offer was 6.75, and the acquirer was Dewhurst. Not the butcher, I hasten to add, but Dewhurst, the lift panel manufacturer. Why would they pay what is obviously a massive premium here? And the reason was very simple, and when I give you the reason, I think the penny will drop. Dewhurst were experiencing eroding margins because of increased Chinese competition for both their panel manufacturer and their service contracts. What they discovered is that TMP's client list included every local authority in the United Kingdom. So suddenly, overnight, Dewhurst now have access to every single local authority in the United Kingdom with a relational sales infrastructure in place through whom they can cross-sell and upsell their lift panel manufacturer and their service contracts. Who wouldn't pay a premium for that? I'm into my last 5 minutes, folks, and I promise to explain the special arrangement and show you how you can both introduce clients and earn fees. Ethically preparing clients for exit. Many young clients, especially tech startups, will approach us to exit, but it's worth remembering this too, isn't it? That HSBC reckon that for most UK accounting firms, 60% of our clients are likely to be in the baby boomer generation, and exit is almost inevitable for that 60% in the next 10 years or less. Now, there is a bespoke partnership arrangement for ICPA members. No cost, by the way, or obligation for you at any stage in this journey. Gives your clients a great opportunity to sell and sell for maximum value, and it provides your firm with free support services. And interestingly, it opens up a new and even better future with the client who ultimately exits grateful and with things to do with their money. Why should ICPA members partner with BCMS? Well, you can ask Tony for his own view on that. I can tell you 2,000 firms in the UK already do. 500 deals in recent years, 100 deals in the last 12 months, roughly. And typically now, for the last 25 years, the average sale price achieved has been 40% above those traditional values that we looked at. And then, of course, all the unique resources that we've discussed together. It's also endorsed, which hopefully will give you a little bit of comfort, as it were. Endorsed by legal professionals, banking groups, including Coutts, Deutsche Bank, Metro Bank, and in our own direct world, Accountancy Age, Insight Marketing, ICPA, My Firm's App, Investec, and many others endorsed this partnering process. The partnering process gives you the best possible outcome for your client, that average of 200 potential buyers, that confidence that the likely outcome is going to be 40% above traditional valuations, confidence that your client gets the best opportunity ever to achieve the best possible price. It also means, folks, that you can bolt on a mergers and acquisitions offering at no cost, and we'll give you support and collateral. We'll give you help wherever you need it with questions around client succession. And we'll offer your clients a free one-to-one business evaluation consultation, or as you're going to see, my favored first step and Tony's favored first step, a free seminar place. The ideal client for the BCMS traditional model is 1 million turnover, great referral fees, by the way, and great payaways, which I'm going to show you. There's also a small service for clients that have turnover between 400 and 900,000, but please note there's no referral fees or payaways for that small service. Where do you get the revenue from then? You'll get the revenue, a very generous revenue, direct from the referral and the ultimate payaway. Additional revenue that you must put your own numbers to. Additional due diligence, compliance consultancy, tax, IHT, perhaps a passive revenue trail from funds under management or future investment for the client, and pension management ingredients. So if you'd been the accountant that recommended this client to BCMS and your client had decided to go ahead, sold for $1 million, as an ICPA member, what would you have received? Well, it sold for $1 million, and you'd have received an absolute number, $3,400 for the referral, an absolute number, $3,000 for your 10% share of the BCMS 3% success fee. So whatever else you did, $6,400 just for introducing the client to BCMS. But then, of course, you're going to do some or all of these things: wealth management, tax strategy, compliance, or advisory work. So the total revenue you're going to have to calculate. What I can tell you is my ingredient in the mix, which is a definite number in this example, would have been $6,400 for you. You'd have perhaps invoiced an additional $10,000, $20,000, $5,000. You tell yourself what that number would have been. Bags of support. Tony was really keen that I make it clear. As an ICPA member, you get brochures, books, and magazines available. Anytime you want a case study for a genuinely interested client, we'll get you a variety by size and sector. I'm regularly delivering webinars with content for accountants, and always my team are at the end of a telephone for advice on exit matters. I'm going to send you a PDF version of my latest book called I Sold Up, but if you'd like some hard copies, you can also access those as well. And there are two ways, as I conclude now, that you can approach this. You can be passive, wait for your client to approach you and then refer them. That's not good. Not good for you, not good for your client either. Or the systemized proactive approach where BCMS does the selling, and the best possible way, and Tony agrees with me on this, bring your client to a free seminar. There's about 50 to 60 a year. There's always going to be one near you every quarter at the very least. And you can ask Tony if you want, ping him an email and ask what he thinks of the seminar. But it's a great way to introduce the client without any sales pitch to the total BCMS approach, just a glimpse of which I've given you today. To help you, within the next 2 hours, I'll be emailing all of you with just a couple of paragraphs of reminder text. I'm going to include this PDF, which is an invitation from you as an accountant to your client to attend the BCMS seminar. And any registration that uses that PDF is automatically tracked back to you. Makes it dead easy to do. So the most effective introduction is invite clients to a seminar. Please come yourself. I'm going to give you a copy so that you can literally cut and paste my text, put it on email or letter and send it straight out to a client. No work for you, cut and paste job only. If you've got any questions around that, use the question dialog box if you're listening to me live, or contact me if you're listening to the broadcast, david.oliver@bcms.co.uk. The 3 core sessions at the free morning seminar: the reasons for selling, 8 keys to getting the best price, and the 11-step sale process. And the outcome is very simple. You and your client understand the value of the business at exit, and you can either explore selling imminently or prepare to help your client sell in a target of X months. You and your clients come away with all the knowledge you need to make right decisions together about the potential of exit, either now or over many years, and hopefully be a little bit inspired about the value. I've put on the screen the next few seminars: Oxford tomorrow, we've still got places, Carlton Tower next week, the Vale Resort the week after, Botley Park the week after that in Southampton, East Midlands Airport, Swindon, Croydon, Leeds, Norwich. All these will be in the email which I'll send. And this brings me to my final slide. Any questions, please use the dialog box. I'll leave it open for a few minutes. I'll be in touch later today by email with 2 attachments and a list of seminar dates and locations. Please do book yourself into one. As my guest, simply hit reply if you want, and my team will do the rest. If you'd like free copies, hard copies of my latest book, I Sold Up, just hit reply if you would, and then tell me how many copies you'd like. At any time, email me for questions, thoughts, or challenges, and my team will support you in any way we can. Again, use the question dialog box or contact me, david.oliver@bcms.co.uk. Just remains for me to say thank you so much for ICPA and Tony Margaritelli hosting today's webinar. Thank you for attending. Take care.